When the IRS sends a final notice that it intends to levy to seize your wages, bank account, or property, most people react with fear and inaction. That is exactly the wrong response. A levy does not happen without a procedural sequence that takes months, sometimes over a year, and provides multiple legally enforceable opportunities to stop it. The IRS cannot legally seize your assets without following specific statutory steps under IRC Section 6330. If you understand those steps, you can intervene at multiple points and, in many cases, prevent seizure entirely. A tax lien and a tax levy are fundamentally different. A federal tax lien is a legal claim, not a seizure. When you owe tax that is assessed, billed, and unpaid after demand, a lien arises automatically under IRC Section 6321, attaching to all your current and future property. The IRS files a Notice of Federal Tax Lien, NFTL, in public records, which alerts creditors and affects your credit. A lien limits your ability to sell property or obtain credit, but it does not itself take anything from you. A levy is the actual seizure of property to satisfy the debt. These are two distinct events with different legal prerequisites. The procedural sequence before levy. First, assessment of the tax liability. Second, notice and demand for payment. The IRS sends a bill. Third, failure to pay within 10 days triggers the lien automatically. Fourth, the IRS sends a final notice of intent to levy, CP90 or Letter 1058, which gives you 30 days to request a collection due process hearing before any levy may proceed. The CDP hearing right is statutory under IRC Section 6330. If you request it in writing within 30 days, all levy action stops until the hearing is concluded. Missing that 30-day window is one of the costliest mistakes a taxpayer can make. The collection due process hearing is conducted by the IRS Independent Office of Appeals. At the hearing, you can raise any viable alternative to collection: an installment agreement, an offer in compromise, currently not collectible status, or challenges to the underlying liability if you never had a prior opportunity to contest it. You can also challenge whether the levy would cause economic hardship. The appeals officer cannot sustain a levy if an installment agreement has been offered and the taxpayer is in compliance with all other filing requirements. The CDP process exists specifically to provide this administrative resolution pathway before enforcement. What the IRS can levy: wages. The IRS sends a continuous wage levy to your employer that continues each pay period until the debt is satisfied or the levy is released. Bank accounts. A bank levy freezes funds on the day received and holds them for 21 days before remitting to the IRS, giving you a window to respond. Accounts receivable. Money your clients owe you. Business assets, equipment, vehicles, real property in extreme cases, and state tax refunds. What the IRS cannot levy without court approval: the primary residence in most circumstances. The IRS must obtain a court order from a federal district court to seize and sell a primary residence. Assets that are statutorily exempt from levy under IRC Section 6334 include unemployment benefits, certain annuity and pension payments up to amounts specified in the code, workers' compensation, income needed for court, ordered child support, minimum wage amounts under a continuous wage levy, the IRS must leave you a defined exempt amount based on your filing status and dependents, public assistance payments, and furniture, personal effects, and business tools not exceeding $9,450 and $4,720. The IRS may not levy property whose value is less than the cost of the levy itself. Filing for a CDP hearing triggers what is known as a levy hold. The IRS cannot proceed with enforcement while the hearing is pending and while any subsequent appeals to tax court are unresolved. This can provide months of additional time to negotiate resolution. However, a CDP hearing is not a delay strategy. It is a substantive proceeding. You must present a genuine alternative to collection. Coming to the hearing without a proposal, without financial documentation, or without professional representation significantly reduces the probability of a favorable outcome and does not prevent the levy from eventually proceeding. The federal tax lien affects your credit and your ability to transact. It appears in public records and shows up in title searches, preventing clean transfer of real property. A lien can be discharged from a specific property, allowing a sale to proceed if the IRS agrees the proceeds will not reduce what it can ultimately collect. A lien can be subordinated, placed below a new mortgage lender's priority if the refinancing proceeds will allow you to pay the IRS debt, and a lien is withdrawn, removed from public record, after full payment, after an accepted OIC, or in specific circumstances under IRS Fresh Start program criteria. Installment agreements release levies and prevent new levies while the agreement is in effect and the taxpayer remains compliant. A streamlined installment agreement for individuals owing $50,000 or less can be set up online at IRS.gov without financial disclosure documentation for up to 72 months. If you owe more, a partial pay installment agreement may be available, under which you pay less than the full monthly amount the IRS would require, with the remaining balance uncollectible after the collection statute expires in 10 years. These are legitimate resolution tools that can be initiated without going through enforcement. The IRS is not able to simply reach into your account the moment you owe taxes. It must follow a statutory collection sequence that provides multiple enforceable opportunities to intervene. The 30-day window on the final notice of intent to levy is the most critical. Missing it forfeits your right to a CDP hearing and the levy hold that comes with it. Act on IRS collection correspondence immediately, understand the difference between a lien and a levy, and explore installment agreements or settlement options before enforcement reaches the seizure stage. If you want to understand how settlement for less than the full amount works, our video on offer in compromise when you can actually settle IRS debt for less than you owe covers the exact rules. Before the IRS can collect, it has to be inside its window. How far back the IRS can go explains the 3-year audit rule, the 6 circumstances that stretch it to 6, and the 2 that remove the limit entirely. It is on this channel.